for tuning in to the Newmarket market update for March of 2026. Let's jump right into looking at the overall market when we're looking at the GTA market. This is kind of a breakdown from what Treb releases on their market watch each month. So first we're going to look at their headline. The market is tightening, but buyers still hold the cards. Current phase is a late buyer's market with early tightening. So we can see at the top right hand side, we have deep buyer's market over to a seller's market. We're sitting just at the beginning of a tightening market. Now, we did have a little bit stronger of a March, so it is leaning towards the more tightening side. But let's face it, there's a lot of different catalysts in this market that could potentially shape it and even bring it back to the deep buyer's market again. Potentially, we'll get into that. So if we're looking at the supply shrinking faster than demand recovers, so we have 16.7% fewer new listings this March compared to last March, and we also saw an uptick of 1.7% more sales this March from last March for the Toronto Real Estate Board. So decline is slowing, the floor may be forming. So prices are year over year still down 6.7%. We have starting to see some month over month strength though as we go into the spring market. So prices on the month over month are starting to flatten out a bit here. And then we're going to jump into the buyers still discounting, sellers conceding. So in some areas today we're going to look at, or for Newmarket, in some of the neighborhoods, we're going to see that some sales to new listings ratios are down to 95%. So sellers are willing to take a bit of a discount here in this particular market. More than likely, they've had the property up for a long time. They've done already a couple of price adjustments, and now buyers come in with a little bit lower of an offer, and they've just taken it. So we'll deep dive into that as well. Sales to new listings ratio is still in a buyer's territory. It's sitting at 34%. Anything below 40%, you're sitting in a buyer's market. 40 to 60 is a balanced market. 60 above is a seller's market. So it's definitely in a buyer's market still when it comes to that. We've had a bunch of rate cuts. We're in a potential interesting year because bond market's telling us maybe 2 rate increases this year. It's hard to believe that that could happen, but based on the data that we're seeing today, we have to assume that that's a possibility. So we need to factor that in. So anyways, this is not a rebound, it's a transition. Supply is retreating, demand is stabilizing, and prices are still soft. That's how every market bottom begins. So we'll look at some charts. We'll see if there's a market bottom starting to take form. Let's see what the data is telling us at the end of the day. The opportunity window, buyers still have leverage and inventory. There's lots of inventory out there. Buyers still have the leverage. There's no doubting that. That will likely be the case for the majority, if not all of the rest of this year. But are we going to come to a point where we're starting to see a leveling out? Prices have started to reach their max. If you're not getting an influx of new listings hitting the market, sales are starting to increase, taking some of that supply out of the market. That's when you start to see a little bit of the tightening. And typically sales will lead prices. So you'll start to see the sales uptick. Prices will start to come beneath them. So if you follow me on a monthly basis, we cover all this data to see where it's heading, right? So what we need to watch for, if April sales hold above the 5,000 and listings stay below 15,000, tightening is potentially confirmed. If listings surge past 18,000 while sales drop, then March was just a seasonal bounce. Any Bank of Canada rate cut could start to bring demand, but like I said, what we're seeing in the market is not suggesting any rate cuts as of right now, but that can change month to month depending on what's going on in the world. And then medium term supply pipeline drying up, 2028 could see a bit of a shortage going there. We're not building a lot of homes right now either. So let's go and look at some charts. This is every March going back to 2015. So how is March compared to last year and Marches in the past? So if we start at the top left on the median price, we can see that we peaked out in March of 2022 here, and it's been a slow decline down. We haven't got back to where prices were at the peak of 2017, but we are starting to get there. And in some other areas, which we might cover, you're going to see that prices have gone back to where they were at the peak of 2017. Transaction volume, we're still way down compared to where we've been in the past for transactions. Little bit of a flattening out there, but we also saw that back in 23 and 24 before it fell again down to 4,965 to 4,880. New listings volume, again, it's fallen down a bit, but it's kind of in a range where it's been at or around where we saw March 5th, 2015 to about March 2020. So we're not getting this market where like new skyrocketing. This is more of a market where things are just not being absorbed on the sale side. So that's why we're getting such a large active and months of inventory. Average days on market, we're sitting at, I can't see it there, but I believe it's in the 30s, which is significantly higher than what we've seen in any other March dating back. And then active listings, historically, we are down to 21,650. So we're down from where we were of March 2025. So that's good to see that active listings have potentially started to peak here. And months of inventory as well, sitting at 4.5 months of inventory. That might have peaked as well. So what we're going to want to see is when April stats come, May stats come, are we seeing similar trends year over year? In those to give us a general idea of, okay, maybe we're to see a floor here. So let's also look at some of the economic pressures that will have an effect on the stats that we're looking at today for the Newmarket market. This left is data that I get from wawa.ca, which is a fantastic resource. And what they're saying basically is there's an 84% chance of a hold in April, 73% chance of a hold in June. This is for the Bank of Canada. And then in July, we've got a little bit of a toss-up here. 53% of a hold, 47% we might get a rate increase, not a decrease. But when it comes to September, they're forecasting a 73% chance of a rate hike. And then in December, an 80% chance of a second rate hike. So when it comes to later this year, we could potentially see two rate, and this has to do with their forecasts on inflation, what's going on in the bond market, the repo market. So this could always change, something you want to see in the short term. I think confidently in the short term for the next two periods of June, we're more than likely not going to see anything happen unless something drastic happens in the economy. On the right side, this is also data from Wawa, which is showing the best rate, average rate, and the change over the last 30 days, 1 year, 2 year, 3 year, 4 year, 3 year fixed, and the 5 year variable. So we can see for the 5 year fixed, the best rate you can get, 3.89. Now, not everyone qualifies that, so let's just be clear on that. Same with the 5 year variable, sitting at 3.35. When we're looking at the average of 10, these are some of the biggest banks, some of the biggest lenders in Canada. It's just an average number. What we see with this, though, is the 30-day change. Are rates increasing, decreasing? Can you get a better rate for a 5 year fix than 4.49%? Probably, if you do some shopping around. But we just want to see are moving in the right direction or the wrong direction. And when it comes to the 5 year fixed, over the last 30 days, it's up 16 basis points. So it's moving in the wrong direction. Variable rates moving in the right direction. It's just, I don't know if there's a ton of people that have an appetite for that. I myself have an appetite for the 5 year variable, but a lot of other people might not. They like the security of the 5 year. The unfortunate part is it's not moving in the right direction right now. And let's look at the macro as well. So we've gone over the Bank of Canada policy rate at 2.25%. We've had a bunch of cuts, but we might see some increases this year. Time will tell. Let's go to the consumer confidence. We're sitting at 49.4. So we did see an uptick of 4%, but the issue is we're still below the neutral, which is 50%. So there's just not a lot of confidence in the market, and that's had a huge effect on a lot of buyers sitting on the sidelines. Yes, price has a lot to do with it. Interest rates have a lot to do with it. But confidence also has something to do with it. There's a lot of, unfortunately, not a lot of confidence in the Canadian economy just because of what's going on with tariffs with the U.S., the war in Iran, which maybe is starting to finally wrap itself up, but time will tell, right? Unemployment rate sitting at 6.7%. It's still technically rising. We'll see what it comes into in the next report. But we need to start seeing the unemployment rate start to roll over and start to move in the right direction, because at the end of the day, the more people looking for jobs, the less people looking for houses as well. When we're looking at the labor force participation rate, it's down to 64.9%, declining from the peak that we saw after COVID of 67.5. Wage growth year over year was actually quite slow compared to some of the other months that we've seen, which was only 2%. So it is a multi-year low, and it's showing some compression there in the wage. And population growth, we're probably going to be negative. We're going to lose people this year, I think. We're definitely not growing at all. So when you factor all these in, you can see that we've got 5 reds, 1 yellow. So when you start to see a housing market bottoming out and starting to move in the right direction, you're typically seeing some of these start to go yellow, more so than what you're seeing with the red. So we still have some definite that are affecting, do we definitively have a floor rate now? Is there still a little bit more pressure to the downside? And each month we've got to keep our eye on this and see which way it's going, right? So let's jump in Newmarket finally and look at. And I thought it was important to say all that, because it really the market. If those aren't moving in the right direction, sometimes it's hard for the community that we're looking at to be moving in that direction as well. So we're looking at Newmarket. Median sale price for March of 2026 was $932,900. This was an increase of 4.2% month over month, but year over year it was down 8.5%, or 87,100. So definitely still staying in the buyer's leverage when it comes to the actions of price. Sales volume was 66. It was a nice uptick from February. We saw a 40% increase, and it was up 22% year over year from last March, which was good to see. New listings was sitting at 212 new listings. This is all home types, by the way. New listings were up by an additional 79 or 60% month over month, but was down 5.8% year over year, which is good to see. Sales to new listings ratio. So how much new listings are being absorbed? So 31%. Anything below 40%, like I said, you're in a buyer's market. 40 to 60 is a balanced market. 60 to 100, you are in a seller's market. So, and this was actually down 4 percentage points from February, so it did get a little bit weaker. Average days on market sitting at 32 days on market, which was an improvement from February's 42 days on market, which is to be expected. But when looking at year over year, last year we were looking at 17 average days on market. So we've gone up 87% when it comes to that. Sales to list price ratio, 97.5, which has improved month over month. But when we're looking at year over year, last year was 99.6%. So definitely sellers are taking a little bit less than they're hoping for, just to get the property moved off. And then the percentage of sales below list price was sitting at 87.9%, which is a big number. It's a lot more than what we saw last year, which was 64.8% was selling below. Now it's 87.9. So all of these things still leaning heavily on the buyer side for the Newmarket area. So let's kind of take the picture here and look at, this is just a chart. We've got detached in the black, semi-detached in the green. We've got orange as townhomes, red condo apartments, which have been super flat, and then condo towns in the dotted green line. So we have seen some upticks when it comes to condo towns, townhomes, semis, and a little uptick in the detached market as well. So good to see that at least the mid-range stuff is starting to move up. Condos super flat. We saw a big influx of new condos hit the market in Newmarket that were finished being built. So if we go down to the bottom here, we're looking at, okay, what kind of market are we in? We're looking at the sales to new listings ratio sitting at 31%, which is sitting in the buyer's market. We need to get up to 40-60 to be anywhere close to a balanced market. So Newmarket is still definitely sitting in the buyer's market. So let's look at Newmarket again, like we looked at York Region. How are Marches comparing to Marches of the past? So first, let's start with the median price. We can actually see that we're sitting at $932,900, and that is below where the average price was in 2017 for March. So if you had bought a property at the peak in March of 2017, you have liquidity in your property unless you've paid your mortgage debt, but its value is less than what it was in 2017. We can see that we peaked out in March of 2021, and it's been a grind down. This has been a large reset. So we are quite the reset happen. We're getting back to numbers that we've seen in quite some time, and it will start to level out. We just don't know when that will be. Transaction volume, we did have a nice little uptick. We went from 54 to 66. So definitely a little bit of strength when it comes to the transaction volume, but we're also coming from extremely low numbers here. So 66 is still nothing to write home about, because if we go back at all the other Marches there, it's not even close, right? New listings volume, again, dropped from 3 years of an incline. We had a little bit of a drop here. If we go back and look in history, we could see that, okay, it's kind of averaging out. We've seen it from March 2011 up till about March 2014. Days on market 32, still sitting sky high as compared to where we've seen it from before. Active listings actually saw an uptick where we saw York Region come down. Active listings has gone up. But months of inventory has fallen. The reason months of inventory has fallen is because new listings has fallen, and also transaction volume has increased. So we are seeing a decrease in the inventory, but it's still sitting at the highest it's been since prior to March 10th. Up, we're looking at the detached market as a whole. So top left corner, this is a score I give it out of 100 to show what kind of strength it's looking at. So I'm scoring it a 40 out of 100, still buyer leaning. Improving though, we are seeing an improvement in the detached market. We got a lot of signal confidence in here because we had 41 sales. So we had a lot of sales, a lot of data to look at to make this. So what's driving the market right now? When it comes to demand, it's the strongest we've seen since 2024. Inventory, 167 active with the spring. So we are seeing the active listings rise, which has lowered the score for this particular point. Prices, 1.1 million price, which down 8.7 year over year. Affordability is still extremely stretched. I think prices still need to come down a little bit, just based on the upside. When we went back to the macro, the wages aren't increasing fast enough to absorb higher fuel costs, higher grocery costs, and a lot of those things, right? And then the macro still sitting at 42. It's definitely having an effect on not only detached but housing types' ability to see some overall. So when we're looking at median price, like I said, 1.1 million, up 2.8% month over month. Sales were up 41% year over year for the detached market. Days on market went down to 27 from 34, which was good to see. Sales price to list price sitting at 97.5%. New listings, though, down 47% month over month. So I think we had a lot of people just take their properties off the market when it comes to the detached side. And then active listings, like I said, we're sitting at 167. And months of inventory has improved month over month from 4.77 down to 4.07. And then sales to new listings ratio, right? This is our barometer to kind of see the relative strength of the market, sitting at 34%. So still definitely sitting in a buyer's market. Next, we have the semi-market. So you can see we're sitting at 30 out of 100 on this side. So definitely a lot more buyer leaning, a lot less demand there. Now, our signal confidence is a little bit lower here because we only had 8 sales as compared to 41. So we do have to keep that in mind when we're looking at the data here. So demand improving, 8 sales versus 3 that we only saw in February. Inventory, 33 active, 4.13 months of inventory. So inventory is still sitting there pretty high. We had 854 on the median sale. We did have low inventory, so that can definitely fluctuate the price point when we see month to month when you only have that many sales. If more higher end townhomes or semis sold, that can deviate the price to a bit higher. So when we get to the neighborhoods, we kind of look at those more on an average basis to give us a better idea of how things are performing because of how little data sometimes you get. And again, the affordability, it's better entry detached, but it's still a little bit elevated on that side. The macro we already know. When it comes to the sales to new listings ratio, sitting at 38%, so a little bit better than what we're seeing with the detached market, but still in a market. Looking at townhomes in Newmarket, sitting at 27, so this is the lowest one we've seen so far. Again, signal confidence is low because we only have 6 townhome sales and 4 townhome sales. So 10 sales in all when you're looking at 2 different segments. It's still thin, so you're only looking at 10 combined sales, which drives the score down. Inventory versus the sale pace, so they're starting to really build up. And then price-wise, you're looking at for a town, $702,000 for a condo town. Again, the affordability is better than the detached side, but the sales to new listing ratio down to 21%, which is the lowest we've seen so far. And then let's look at the condo market. It's sitting slightly above where we saw the towns and condo towns at 28. Signal confidence is still very low because we only had 7 sales. The days on market sitting at 62 days on market for the condo, so that's extremely high. Sales to list price 96.9%. So condo owners are definitely taking offers are coming in. They're just not having that leverage to anywhere higher up to their asking price. And again, listings ratio sitting at 39%. So actually, out of all the housing types, we're a little bit more absorption on the new listings for condos than some of the other. One thing I wanted to highlight was looking at a townhome move up to a detached. This is basically at the bottom here is showing the spread between a townhome and a detached. So in the red, the spread is widened. You're going to need to spend $400,000, $500,000, $550,000 more to purchase a detached selling your townhome. But right now we're sitting at below 300,000. We're probably sitting around 275,000. So the spread between the two is very attractive right now. Detached prices have come down. Townhomes have stagnated. You can see we've had an uptick in the townhomes as buyers have jumped into more on the semi and the townhome side. So the price between the two has come down. We can see over the last 3 months, it's been working its way down. So if you're in the market, living in a townhome, you're thinking of going up to a detached home, now might be time to at least explore with a mortgage broker what that would look like, what the payments would look like, because it's going to get to a point where spread starts to widen again. And it's going to cost a lot more to move up to that detached, even if interest rates come down. That will cause the spread to be higher. So definitely something to keep an eye on, and to reach out to a mortgage broker or myself to ask, hey, does this make sense for me? This is where my townhome is. This is where the detached I'm looking. What are we looking at here? Let's look at a few of the neighborhoods. Which ones have kind of really been doing strong? And really comes down to Huron Heights, Leslie Valley. When we look at their sales to new listings ratio over a 3-month period, all the data is over a 3-month period. Excuse me. It's sitting at 46%. So definitely some strength there. Our confidence is high because of how many sales that we had during that time. So definitely a much more balanced market in Newmarket, in the Huron Heights, Leslie Valley market. And that's because I think prices have really gotten to a point where first-time home buyers, maybe even downsizers are willing to step into these smaller detached homes, semis. It's definitely a little more desirable there for them. We're looking at 3.61 average months of inventory, which is quite low. The days on market is pretty high at 41 days, but the average sales to list price, 98%. So sellers are getting a lot closer to what they were hoping for than a lot of other areas. The other two that I would mention here that have, or at least held up close to a balanced market is the Gorham College Manor in the central Newmarket. They're both sitting at 38% sales to new listings ratio. Months of inventory, at least on the Gorham side, is at 4.6 months of inventory. Sales to list price sitting at 97. Central Newmarket, they're still sitting at quite a high months of inventory at 6 months. Definitely very buyers leaning. And pretty much same has to go with a lot of the other areas here: Woodland Hills, Armitage, Bristol, London. And if we're looking at some of the slower performers here, Stonehaven, so definitely a lot higher end on the product side. Money's just not there right now, so you're see prices, or sorry, inventory pile up. Days on market surprisingly quite low. I think they're definitely repricing their properties more attractively, and that's why you're seeing them move a little bit faster, because they've already did price adjustments and they're getting a little bit closer to what they were asking for. But the sales to new listings ratio sitting at 28%, definitely in a deep buyer's market. Summerhill Estates and Glenway Estates, 21%, 26%. You know, very buyer leaning markets there. Let's look at the rental market. If you own a rental property in Newmarket, or you're a renter or a landlord, and you kind of want to get a gist of what's going on in the Newmarket area, we can see that rents are quite low. We saw quite the dip to start the year in December and January, and we're starting to move back up. As we get into the spring, we should start to move back up. Prices should start to recover. But we're definitely not going to peak out where we've been before. I think we'll be lucky to get up to the median average line of around 2,650, 2,700. We did have quite a few leases last month at 109 in Newmarket. The median price was $2,200. Months of inventory 1.28, so very tight market. And so when we look at the sales to new listings ratio, 78, this is a completely different market than what we're seeing in the resale market. Resale market taking a lot longer for things to be absorbed, whereas sales to new listings ratio, rental side, definitely absorbing quite quickly. Rental price though down 17% year over year. Definitely quite the carve out to start the year here. We'll see how well it recovers in the next couple months. So let's look at the one bedroom rental. It's been a very steady market. We can see by the price since January of 2021 onwards, there's still a lot of demand for this. The months of inventory is less than a month of inventory, so it's very, very tight there. And then the new ratio for a one bedroom is actually over 103. So a very tight market for the one. It is the healthiest of all the bedroom types. When we're looking at the two bedroom rental market, we can see that the lease sales to, or lease to new lease ratio is around months of inventory 1.46. We did see them come down quite a bit here, but we've also seen quite a bit of in other months here. So I think it's very easy to as spring starts to happen in summer, we're going to see prices start to elevate back up. So two bedrooms are not as bad, well, but when we get into the three bedroom, we can see that prices have come down. Prices are weakening in the three bedroom market. There isn't a large supply for these. These are a lot of family type units. Again, population isn't growing. New Canadians coming in with families are not growing. So we are starting to see a weakening when it comes to the three bedroom model. Four bedroom, same. We're starting to see prices weaken. We're getting below the average. We've been below the average as well. We will come up coming into the spring, but I don't think to be beating last year's prices. Sales to new listings ratio at 62%, not a far cry from the 103 we saw with the one bedroom. Still a tight months of inventory at 1.69, but definitely a market that's struggling a little. So that's it for the month of March for Newmarket. If you guys have any questions about any of the data here, or you're wondering what your home is worth, or you're thinking about moving to Newmarket and you want some more information, I've got fantastic data for all types, whether you're looking to buy, to invest, any of that. Please reach out to me. My information's on the screen. Go to meetmatthew.ca and I'd be more than happy to help. See you guys in the next one.